Hello, Avila Advantage students. We are now in week 5. We are officially halfway done with the course, so we're on the downhill now. So again, just stay on top of things. Think about your company analysis too. Jump into the forum discussion early this week. Continue with your weekly quizzes, your homework. Do send me emails if you have questions. But this week we move on to the last 3 market structures. We're going to look at monopoly, oligopoly, and monopolistic competition. And the video this week will be a little bit more brief, but I do want to give you some insights as you go along with your readings this week to help you think about it. And we have an interesting forum discussion this week too. I picked it out on Friday, and it I felt worked well with our discussion on competition this week. So I'll let you jump in there and add your value and add your opinion. So first, with the idea of monopoly. Last week we looked at perfect competition. Now we go to the other extreme where there's only one provider in the market. And with a monopoly, you can either have a natural monopoly that often exists with like utility companies where they're regulated. And the idea is that it's better off to have one utility company, example like one gas company, because if you have multiple gas companies, you'd have probably pipes running everywhere through everybody's yards. So what we do is we allow them to grow big. And by growing big, they're experiencing economies of scale, lower average total cost, and usually the monopolies are regulated. And that's a legal monopoly in the United States. For the most part, monopolies are not legal in the United States. If you work in collusion, that's considered illegal. But you could also have other types of monopolies that might be granted temporary monopoly status. For example, if you have a trademark or a patent, that we allow them to earn some economic profits for a period of time to regain some of their research and development cost. And after that patent expires, then it's open to all competition. So one of the main things to remember about monopoly is because they don't have any competition, they can potentially earn an economic profit in the long run. That's why under a natural monopoly, usually the utility companies like KCP&L locally would be allowed to earn a normal profit, might be an 8% rate of return, but they're not allowed to earn excessive profits, and they have to go before regulatory boards every once in a while to say what is a reasonable profit and why are we allowed to increase price so much. Now, with monopolies, they're going to make the same decision as we saw with perfect competition. You're going to decide to produce output where marginal revenue is exactly equal to marginal cost. So the difference now is with perfect competition, well, that marginal revenue curve was the same as the demand curve, was that flat, elastic. Now the marginal revenue curve is going to be derived from the demand curve, and it's going to be downward sloping, but you're going to have an upward sloping marginal cost, downward sloping marginal revenue. It's where those two intersect is the quantity point. But we got to remember, it's not where they intersect is the price. We have to go all the way up to the demand curve and across to see what that price is. And again, that price, just like the 4 scenarios we looked at last week, if the price is greater than average total cost, they're earning an economic profit. If their exact price is exactly equal to average total cost, it's a normal profit. A little less likely for monopoly, but if the price was between average total cost and average variable costs, we continue to produce in the short run to cover some of those fixed costs, and if the price was exactly equal to average variable cost or below, that would be the shutdown point. So you would hope less likely to happen to have a shutdown point when you're a monopolist, but just being a monopolist doesn't guarantee that you're going to be profitable, because if nobody wants your product, it means they're not going to buy it and you're not going to be profitable. So looking at the other stream, monopolistic competition. Actually, this is probably the most common market structure out there, or for a business to be a monopolistic competition. I like to think of it as like the fast food restaurant. You have Burger King, Wendy's, McDonald's. It's competition in the sense that basically they're all producing soda, French fries, hamburger. How they differentiate themselves, maybe Burger King flame broils, McDonald's sticks it in a microwave, Wendy's cooks it on a grill. This is all ways and taste and differences that they try to distinguish themselves. So that's where the monopoly part comes in. So they try to make you loyal customers, and they spend a lot of money on advertising to try to convince you to come into their store and buy their products. So some of the characteristics of this market: there's easy entry and exit. They're still going to make that decision to produce where marginal revenue equals marginal cost. It's going to look very similar, about the same thing we talk about in monopoly. But they're not necessarily going to be at the lowest point of their average total cost curve. They're probably going to be at a higher, they will be at a higher point than would exist in like perfect competition. So they have to fine tune and adjust all the time with advertising, cost, product differentiation to stay competitive in the markets. And the last one is with oligopoly. And in fact, kind of the forum discussion I put out there this week with the home smart speakers is somewhat probably an oligopoly situation now. It sounds like Amazon maybe has the first mover advantage. But with oligopoly, it's a little bit different pricing strategy. It may be more based on interdependent decisions. What does my rival do? If my rival does this, then I'm going to do this. If they set price here, then I'm going to set price here. And what you're going to read about in this chapter is a little bit about starting off with a prisoner's dilemma and looking at scenarios and what would be my rivals, what's my best thing to do based on what I think my rival is going to do. And you're going to work towards what's called a Nash equilibrium. And I put a PDF out there that you can kind of click through, and that will help a little bit with your homework problems too. You can either do a cooperative strategy where both would maybe agree to charge a high price or not compete against each other, but that's not realistic in markets. So sometimes even with competition, there can be dominant strategies that maybe one firm always prices low, the other firm prices high, but they have to make a choice based on what they think their rival is going to do and what's going to maximize their profit. Oftentimes in these market structures too, sometimes profit is sacrificed for market structure, or market share, I should say. And that's a questionable thing to do from a management perspective too. Can you continue to do this for a long time, kind of eating away at each other, but we're never really making a profit because we're always competing so much on price? So I think you will find this week's readings interesting. I am interested to hear what your thoughts in the forum discussion. But if you do have any questions, do send me an email. And otherwise, I'll look forward to talking to you online. Have a great week.